For many, the stock market seems like a mysterious entity, driven by complex forces beyond understanding. But what if I told you that the power to unlock its secrets lies within your grasp? Yes, even if you're just starting out. Did you know that over $95 trillion circulates in global equity markets, yet a significant portion of individual investors struggle to achieve consistent returns? It's not for lack of trying but often due to a lack of understanding. The truth is, investing in stocks doesn't have to be a gamble. With the right knowledge and tools, you can analyze any stock in just 15 minutes, making informed decisions that set you on the path to financial success. In this journey we're about to embark on, we'll demystify stock analysis, breaking it down into digestible, easy-to-understand chapters. From reading financial statements to decoding market sentiment, we'll cover the essential strategies that seasoned investors use to sift through thousands of stocks to find those golden opportunities. But why should you care about stock analysis? Consider this. A study showed that investors who actively analyze stocks achieve an average return that's 3% higher per year than those who don't. Over 30 years, this could mean the difference between retiring with $500,000 or $1.3 million. Surprised? That's just a glimpse of the power of informed investing. So, whether you dream of building a massive investment portfolio or simply securing your financial future, you're in the right place. No more guessing. No more following the crowd. It's time to take control of your investment decisions, using proven strategies that cut through the noise and hype. Get ready to embark on an enlightening journey through the world of stock analysis. By the end of this guide, you'll not only understand how to analyze any stock in 15 minutes, but you'll also possess the confidence to make investment choices that align with your financial goals. Let's unlock the secrets of the stock market together and pave your way to investment success. Chapter 1. Introduction to Stock Analysis. Welcome to the world of investing, where the ability to analyze stocks can be your golden ticket to financial freedom. But why is stock analysis so crucial, you might wonder? Imagine buying a car without checking its engine or mileage. Sounds risky, right? That's exactly the case with investing in stocks without analysis. It's like shooting arrows in the dark. Stock analysis isn't just for the Wall Street experts, it's a skill that you, as a beginner, can quickly learn and apply. It helps you peek under the hood of a company, beyond the stock price fluctuations. You'll understand not just what to buy, but when to buy, ensuring your investment grows over time. Now, you might think, but I'm not a finance expert. That's perfectly okay. The beauty of stock analysis is that it's not exclusive to those with finance degrees. With the right tools and a bit of patience, anyone can learn to make informed decisions, paving the way to a robust investment portfolio. One of the first steps in stock analysis is understanding the types of analysis, fundamental and technical. While fundamental analysis looks at companies' health and potential for growth, technical analysis focuses on stock price movements and market trends. Both are essential, like two sides of the same coin, and we'll dive deeper into these in the upcoming chapters. Chapter 2. The Power of Financial Statements. Financial statements are the backbone of stock analysis. They tell you everything about a company's financial health, from how much debt it has to how much profit it makes. There are three main types: income statements, balance sheets, and cash flow statements. The income statement is like the company's report card, showing revenues, expenses, and profits over a specific period. It answers the question, is the company making money? But making money isn't enough if it's not more than what's being spent. That's where the profit, or net income, shines, revealing if the company is financially healthy. Next up is the balance sheet, which gives you a snapshot of the company's assets, liabilities, and shareholders' equity at a specific point in time. Think of it as a financial scale, balancing what the company owns against what it owes. The key here is to look for a strong, stable foundation with more assets than liabilities. Then, we have the cash flow statement, which shows how much cash is coming in and going out of the business. It's crucial because a company needs cash to pay its bills, invest in new projects, and return money to shareholders. Positive cash flow indicates that a company can sustain its operations and grow, while negative cash flow could signal trouble ahead. By analyzing these statements, you'll get a comprehensive view of a company's financial health, enabling you to make more informed investment decisions. It's like having X-ray vision, seeing beyond the surface to the financial core of the company. Chapter 3. Fundamental Analysis 101. So, you've gotten a handle on financial statements and you're probably wondering, what's next? Enter the realm of fundamental analysis, the cornerstone of making smart investment choices. At its heart, fundamental analysis is about getting to the core of a company's true value, beyond the buzz and the hype. It's like being a detective, where clues are in earnings reports, industry trends, and economic indicators. The essence of fundamental analysis lies in understanding that a stock's current price might not reflect its true value. For instance, a stock could be undervalued due to market overreactions to short-term news. This discrepancy is where savvy investors find opportunities. Think of it as buying a great book at a discount because the cover's a bit dented. Inside, the story's just as compelling. One fundamental concept you'll come across is earnings per share, EPS, which tells you how much profit a company makes for each share of stock. A rising EPS is a good sign. It usually means the company is growing and becoming more profitable. Another key metric is the price-to-earnings (PE) ratio, which compares a company's stock price to its EPS. A lower PE might indicate an undervalued stock, or it could reflect risks or challenges the company faces. But fundamental analysis isn't just about numbers. It also involves understanding the business itself, its competitive advantage, leadership, and market position. Ask yourself, does the company have a product or service that's hard for competitors to replicate? Is its management team experienced and trustworthy? Answers to these questions can give you insights into the company's potential for long-term growth. Chapter 4. Technical Analysis Tactics. While fundamental analysis gives us a deep dive into a company's value, technical analysis switches gears, focusing on price movements and market trends. Imagine you're a weather forecaster, but instead of predicting storms, you're predicting market trends. That's the world of technical analysis. Technical analysts live by charts. They believe that price movements and trading volumes can signal future market trends, independent of the company's financial health. It's based on the idea that history tends to repeat itself, and market psychology plays a significant role in stock prices. One of the first things you'll learn in technical analysis is how to read stock charts. Candlestick charts, for example, can tell you a lot about market sentiment in a short period. A candlestick has 4 points: open, close, high, and low. Its color and shape can indicate whether the trading session ended on a positive or negative note, providing clues about future movements. Technical analysis also involves a variety of indicators and patterns, from simple moving averages, SMA, to complex Fibonacci retracements. These tools help analysts identify trends and make predictions about where the market is headed. For instance, if a stock's price crosses above its 200-day SMA, it might indicate a long-term upward trend. But remember, technical analysis is more about probabilities than certainties. It's not a crystal ball, but it can give you an edge in identifying potential entry and exit points for your investments. The key is to combine it with fundamental analysis for a well-rounded view. Like using both a map and a compass on a hike, these two approaches together can help you navigate the complex terrain of the stock market. Chapter 5. Key ratios and what they mean. Now that we've explored the realms of fundamental and technical analysis, it's time to sharpen our tools even further with key financial ratios. These ratios can seem like a maze at first, but they're actually your secret decoder ring for understanding a company's financial health and stock value. First up, let's talk about the price-to-earnings (PE) ratio again, but this time, let's dive deeper. The PE ratio compares a company's share price to its earnings per share, EPS. A high PE ratio could mean the stock is overvalued, or investors are expecting high growth rates in the future. On the other hand, a low PE might indicate an undervalued stock or a company facing challenges. The trick is to compare the PE ratio with other companies in the same industry to get a sense of what's typical. Another crucial metric is the debt-to-equity (DE) ratio, which measures a company's financial leverage by comparing its total liabilities to shareholders' equity. A high DE ratio indicates that a company is funding its growth through debt, which can be risky if not managed properly. However, some industries, like utilities and telecommunications, naturally have higher DE ratios due to their heavy infrastructure investments. The return on equity, ROE, is a favorite among investors because it shows how efficiently a company uses its assets to generate profits. A high ROE is generally a good sign, indicating effective management and a strong business model. But beware, an extremely high ROE could be due to excessive debt, so it's always best to look at the bigger picture. Don't forget about the price-to-book (PB) ratio, which compares a company's market value to its book value. A PB ratio below 1 could mean the stock is undervalued relative to its assets, offering a potential bargain for investors. However, it could also indicate underlying problems within the company, so thorough research is crucial. These ratios, along with others like the price-to-sales (PS) and price-to-cash flow (PCF), are vital tools in your stock analysis toolkit. They help you compare companies within the same sector, understand market expectations, and spot potential investment opportunities. Like any tool, though, they're most effective when used as part of a broader analysis strategy, combining both the quantitative and qualitative aspects of a company. Chapter 6. Understanding the market sentiment. Moving beyond the numbers, let's tune into the market's heartbeat, sentiment. Market sentiment is the overall attitude of investors toward a particular stock or the stock market in general. It's a powerful force that can drive stock prices up or down, regardless of the company's financials. Think of it as the stock market's mood, influenced by news, events, and investor perception. One way to gauge market sentiment is through the volatility index, VIX, often called the fear index. When the VIX is high, it suggests that investors are worried and expect significant price fluctuations. Conversely, a low VIX indicates confidence and stability in the market. Social media and financial news are also barometers of sentiment. A positive news article or a viral tweet can send a stock soaring, while negative press can cause a sharp decline. In this digital age, information travels fast, and sentiment can shift in the blink of an eye. Another sentiment indicator is the put-call ratio, which compares the trading volume of put options to call options. A high ratio suggests bearish sentiment, as more investors are betting on stock prices to fall. Conversely, a low ratio indicates bullish sentiment, with expectations for rising stock prices. Understanding market sentiment is crucial, but it requires a balance. While sentiment can offer trading opportunities, it's also prone to sudden shifts, making it a volatile basis for long-term investment decisions. Successful investors monitor sentiment to time their trades but rely on thorough analysis to build a solid investment foundation. As you've seen, stock analysis is as much about understanding numbers as it is about interpreting the market's mood. In the following chapters, we'll explore different investment styles and how news and events can impact stock prices, further rounding out your stock analysis education. Chapter 7. Growth versus value stocks. Diving deeper into the investment world, you'll soon discover two main styles: growth investing and value investing. Think of them as different paths to the same destination, financial success. Both have their champions and critics, but understanding the difference is key to shaping your investment strategy. Growth stocks are the high flyers of the stock market, companies expected to grow at an above-average rate compared to their industry or the overall market. They're often tech or biotech companies, innovating and expanding rapidly. However, with high potential comes high risk. These stocks are usually more expensive, reflected in higher P/E ratios, and they reinvest earnings into the company rather than paying dividends. Investors are betting on future profits, which might take time to materialize. Imagine buying a small sapling, nurturing it as it grows into a towering tree. That's growth investing. You're paying for what the company could become, the potential for substantial future returns. The key is to identify companies with scalable products or services, strong competitive advantages, and adept management teams. Value stocks, on the other hand, are the market's underappreciated gems. They're companies trading below what they're essentially worth, often due to being out of favor with investors. Think of it as finding a high-quality item on sale. Value stocks might be in industries experiencing temporary setbacks or companies that have been overlooked. They often pay dividends, providing income while you wait for the stock to rebound to its true value. Choosing value stocks is like buying an old, rare book at a discount, knowing its worth will be recognized in time. The trick is to look for solid companies with strong fundamentals, good earnings, low debt, and healthy cash flow, that are trading at a bargain price due to temporary factors. Both growth and value investing have their merits and risks. Some investors prefer one strategy over the other, while many blend the two, seeking both growth potential and undervalued opportunities. Your choice depends on your financial goals, risk tolerance, and investment horizon. Like any strategy, diversification is key. Don't put all your eggs in one basket, whether it's all growth, all value, or even all in one sector.